Most traders sit on the sidelines during a bear market, paralyzed by fear or waiting for the perfect bottom to magically appear. But that's exactly when elite traders quietly prepare to strike. They're not guessing bottoms. They're not trying to buy cheap stocks. They're doing something much smarter. They're identifying future leaders, stocks that will lead the next bull market, and they're often buying them while the market is still in a mess. This approach, championed by both two-time US investing champion Mark Minervini and the author of the best-selling book How to Make Money in Stocks, William O'Neill, is how some of the biggest winners in market history were discovered, not during booms, but in the heart of downturns. Therefore, in today's video, we discuss how you can spot leaders in a bear market to compound your trading capital much faster than the market. The truth is, almost all super-performing stocks, those with gains of 300, 500, and even 1,000%, start their moves not in bull markets, but coming out of corrections and bear markets. This is the golden window. And ironically, it's the time most traders are the most fearful and least willing to act. Why? Because fear blinds them. But those who understand what to look for, those who trust price, volume, and relative strength, can see the signals clearly. The potential leadership can be divided into three types based on timing: predictive, coincident, and confirming. Predictive stocks start showing strength before the market bottoms. Coincident stocks break out around the same time the market starts turning up, and confirming stocks break out after the market has begun to recover, providing additional validation. Depending on the bear market's shape, whether it's a V-bottom like COVID-19 or a grinding, drawn-out bottom like 2002, different types of setup dominate. But in every case, the signs are there if you know where to look. The mechanism to identify potential leaders hasn't changed in decades. For example, if we go back to 1990, the US entered a recession. Oil spiked due to the Gulf War, consumer confidence fell, and the market dropped sharply. But while most stocks collapsed, one stock, Amgen, was quietly climbing. While the Nasdaq and S&P were still heading down, Amgen was already forming a tight base and breaking into new highs. This is a classic example of a predictive leader. By the time the general market bottomed, Amgen had already launched. It went on to gain more than 350% in just over a year. Minervini calls this a sore thumb, a stock that sticks out because it completely ignores the market's downtrend. These are the early leaders. They don't just survive corrections, they thrive through them. The same was the case with the pharma company Eli Lilly, or LLY, in 2022, when the S&P 500 was in a decline, but Eli Lilly's stock continued to reach new highs. The stock formed a few bases along the way, including our preferred lateral consolidations on the weekly chart. The stock was up 22% when the S&P 500 was down 23%. The stock continued to perform after the market bottomed, clocking a 220% return against the S&P 500's 69% return in 18 months. Let's look at Amazon during the 2000 to 2002 bear market. The Nasdaq fell nearly 78% over those 2 years. Tech stocks were being destroyed. But by late 2002, Amazon had formed a powerful cup-with-handle base. It did not participate in the last leg of the market's fall, but began rising before the market had officially bottomed in 2003. Those who waited for the perfect signal from the broader indices missed a massive move. Amazon doubled before the Nasdaq even found its footing. The same was the case with Netflix in 2008. While Blockbuster was dying, Netflix was forming its leadership run. In 2008, the market was still heading lower, but Netflix had already begun its move. By the time the S&P hit its final bottom in March 2009, Netflix was already up over 100%. That's not luck, that's leadership. Let's now look at an example of coincident leadership. Here is Chipotle's chart from 2010. The market had just experienced the Great Recession. The S&P had fallen 57% from peak to trough. But CMG built a tight base right after the flash crash in May 2010, and when it broke out, it didn't just rise, it exploded. And here is an example of confirming leadership. In 2022, NVIDIA bottomed at around the same time as the S&P 500. However, its recovery was swift, as it touched new highs before the market did. As the market was still recovering from the fall, NVIDIA formed a lateral consolidation base with very tight price formation on the right. As it broke out from the base at $50 in January 2024, it rallied over 200% in 12 months against the S&P 500's 22% return in the same period. So what are the traits of these stocks that tell you they're likely to be leaders? There are 5 key things to look for. First, the stock should have corrected the least during the market decline. This tells you it has relative strength. Forget the names down 80%. Focus on stocks 10 to 20% down, or even making new highs. Second, they should be forming bases or tight consolidations during the bear market. Sideways movement while the market is heading down is a powerful sign of strength. Third, look for the fastest and sharpest rebounds off the lows, like DocuSign and Zoom in 2020. These quick movers are flashing institutional demand. Fourth, pay close attention to IPOs. Some of the biggest winners, like Amazon, Chipotle, and Facebook, made their first massive runs coming off market corrections. The best time to buy recent IPOs is after their first base, what Minervini calls a primary base, especially during or right after a bear market. And finally, you want proliferation. 1 or 2 strong names could be false positives, but when you start to see 10, 20, or even 50 stocks setting up tight bases with relative strength, and they start to break out on volume, that's your cue. Leadership is emerging, and the tide is turning. During the COVID-19 crash of 2020, for example, the market fell 35% in just 23 trading days. It was one of the fastest collapses in history. But by early April, stocks like Teladoc, Peloton, and Shopify were already breaking into new high ground. Teladoc never even closed below its 50-day moving average. In just 3 days after the market bottomed, it was at all-time highs. That kind of strength isn't random, it's a roadmap. An important tool in your arsenal to find leadership can be the relative strength. Tools like the RS line blue dot on MarketSmith help identify stocks where the RS line is making new highs even before price confirms. These are the names to stalk. They're often showing up when nobody else is paying attention, while the headlines are still screaming recession or crash. And here's something most traders overlook. New leaders are almost never the old leaders. Amazon, Apple, and Microsoft were all hated when they began their monster runs. In the 70s, Eastman, Kodak, and Avon were the big names, and by the 80s, they were dead money. Every cycle has its own leaders, and your job is not to find the next Microsoft, it's to find the unknown stock today that will be the Microsoft of the next cycle. But don't just focus on one buy point. Great stocks often offer multiple chances. They form a base and break out, and then they form another base and break out again. Stocks like Square, NVIDIA, and Shopify gave traders several high-quality entries across different stages of a bull cycle. Miss the first one? No problem. Stay alert, stay engaged. The second or third setup might be even better, tighter, with less risk and more confirmation. That brings us to a key point. In bear markets, cash is a position. The goal isn't to go all in, it's to build selectively. Put a toe in the water. Buy a small position, and if it works, you scale. If it doesn't, you cut quickly. As Minervini says, do not look for the lowest price. Look for the right price. The right price is the one that tells you immediately if you're right or wrong. Good trades move quickly. Bad trades stall or fail. You need to be just as quick to cut as you are to commit. Bear markets feel scary, and that's by design. That's why they create opportunity. When sentiment is at its worst, when everyone's convinced it's going to get worse, that's often when new leaders begin to emerge. The markets repeat these patterns in every bear market. The same 5 traits show up, the same emotional cycle unfolds, and every time the traders who put in the work, who focus on strengths and setups, walk away with the biggest gains. So, if you're sitting in a bear market right now, stop waiting for a bell to ring. Start running your screens. Start tracking relative strength. Watch for bases forming while the market is still bleeding. When you see strength in a sea of weakness, pay attention. It might just be the next Amgen, the next Amazon, the next Netflix, or the next NVIDIA. Our community has a bespoke breakout scanner for finding such quality stocks breaking out of consolidation, with other momentum factors in its favor. Feel free to join us in the quest of trading the best stocks at the right moment using the links below. As always, thanks for watching.